Can you guys see and hear me okay?
I'm not sure if the meeting started yet, but I think they just went off mute.
No, we haven't started yet. We're waiting.
Okay,
on
thank
Mr.
you.
We're waiting on Mr. Cummins to log on.
Okay, thank you.
Is he? He's not in yet.
I'm in. Good day.
Okay, I think we're ready. We're going to go ahead and call this meeting to order. This is our March 16th, 2021 Police Officers Retirement Plan meeting. First item on the agenda is our swearing in of our new member, which is Mr. Ashton Cassidy. And so, your Sergeant, Lieutenant Cassidy. Lieutenant Cassidy, if you'll join Ms. Krantz over at the podium, she'll go ahead and swear you in.
Lieutenant, if you would raise your right hand and put your left hand on the Bible. I, Ashton Cassidy,
I, Ashton Cassidy,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support, protect, and defend the Constitution
that I will support, protect, and defend the Constitution
and government of the United States
and government of the United States
and of the state of Florida
and of the state of Florida
and the charter and ordinances of the city of Palatka,
and the charter and ordinances of the city of Palatka,
that I am duly qualified to hold office
that I am duly qualified to hold office
under the Constitution of the state,
under the Constitution of the state,
and that I will well and faithfully perform
and that I will well and faithfully perform
the duties of police officers pension board member
the duties of police officers pension board member
on which I am about to enter.
on which I am about to enter.
So help me God.
So help me God.
Welcome aboard, Lieutenant.
Thank you.
All right, welcome aboard, LT. At this time, we'll have our roll call. Here.
Scott Mast,
Here.
Ashton Cassidy,
Here.
Greg Cummings.
Here.
We have a quorum.
And just for the record, all members are here and accounted for. And we have one vacancy on the board. Next on our agenda is approval of our minutes. Has everyone had an opportunity to review the minutes from the December 15th meeting? If so, I'll entertain a motion.
Scott Mast, motion to accept the minutes from the last meeting.
There's a motion on the floor. Is there a second? There's a motion on the floor and a second by Lieutenant Cassidy. All in favor, say aye.
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 Opposed, motion carries unanimously. Thank you. Moving on, foster and foster evaluation report for fiscal year 2020. Patrick.
I'm going to try to share my screen here. Hold on one second. All right, so hopefully everybody can see. Oh, wait, sorry. Now can you guys see it?
Yes, sir.
So
I can see it.
every year, as of October 1st, we look at the assets in the pension plan and then we project out all the future retirement benefits to determine an appropriate funding requirement for the next year. And we always do it 1 year ahead so that the city can budget. So the right-hand column there is last year's valuation report. It looked at all the information as of October 1, 2019. And it determined the funding requirements for the year that we're in right now. And the left-hand column is this year's valuation for next year. And you can see the costs went up a little bit. The total required went from 30.3% to 34.6% of payroll. Then when you take away the members and the state contributions, the city goes from about 19.1% of payroll to about 23.4% of payroll. And there's all kinds of different reasons for that. So first, I usually look at the assets, and that's on page 30. But for the 1 year ending 9/30/20, we had expected to get 7.6% on our investments, and we got 8.78%. So that's good. Even in the midst of the pandemic, we ended up with we beat the assumption for the 1 year. And then we always use a rolling 4-year average to determine the new actuarial value of assets, the value that we use for the actuarial valuation. And so the 4-year average was 7.7%. So just slightly above the 7.6% assumption over that 4-year period. One thing, there's 3 changes in this report, and one of them is that we're gonna fresh start the smoothing technique. So we're basically gonna start over and say 10/1/2020, the market value of assets equals the actuarial value of assets. And then each year going forward, we're gonna spread our gains and losses out over 5 years. So it's gonna be a 5-year smoothing instead of a 4. And the math will be a little bit different in that if we get a $500,000 gain next, we're going to spread that gain and recognize 100,000 each of the next 5 years. So it's a little better mathematically than this rolling average that we were using. And it's going to be a 5-year smoothing instead of a 4. So it should be a little more smooth than the method that we're using right now. And I'm recommending this for all of my clients. So they're really, you're not going to have to worry about that 3.58% anymore because we're starting over this year.
Hey, Patrick,
Yes?
Burgess here. You were at 4-year smoothing before, and now you've gone to a 5-year. And in order to make that shift, you had to do a restart.
Yeah.
Right.
And also, like I said, instead of using average percentages, we're just going to take the dollar amount that we get extra each year and spread that over 5 years. So the the method's slightly different.
Does does what you did increase the funding ratio?
Well, for the 1 year, for this transition here, it made it worse. Because our actuarial value using that smoothing, we were using 12.1 million, 12,153,000. And the market value is 11,831,000. So it's about $320,000 less. So we were kind of using more for valuation purposes with that smoothing. We were kind of pretending we had more assets in there than we really did. So when I started it over and set it equal to the true market value, that created an actuarial loss this year.
Thank you.
But like I said, the flip side of that is that next year we were going to drop off the 11.32 and average the last 3 years plus this year. And so that 3.58 was going to bring down. So we were going to be coming down each year over the next few years in that, using the old smoothing technique. So now we really just recognize it all right away. And now if we get gains this year, then we'll have gains. Rather than if we would have had gains this year, we would have had an actuarial loss because of the smoothing. if that makes sense.
So does that increase the contribution? Is that what increases the contribution?
That was a little bit of what increased the contribution, yes.
Patrick, Greg Cummings here. How do you handle a loss or a negative return for a year?
Well, next starting now, so if in 2021, we're expecting 7.5, because that's another thing we did in this report, we changed the assumption from 7.6 to 7.5. But so for the future, we're assuming 7.5. If we get 8.5, so we get an actuarial gain of say $1 million, we're going to recognize 200,000 of that gain in 2021, and then another 200,000 in 2022, and so on. That's how we're going to do it going forward. Does that answer the question?
I think it gets after it. It is more so if we actually had a loss, we will level that loss out with any gains from the previous years that are still being added. But okay, thank you.
Exactly, right. So if in year one, we get a $1 million gain and we recognize 200,000 each year, and in year two, we get $1 million loss, well, we're going to recognize 200,000 of that loss. And we're also going to recognize 200,000 of the previous gain. And there's going to be no impact on the actuarial value of assets. So the smoothing will still work, just slightly differently. So then part of what affects the funding each year is the turnover and mortality. And so last year you had 29 non-drop and 2 people in the drop. And you actually had 9 people terminate non-retirement. And you had 1 person enter the drop, and you hired 8 new people. So you went from 29 to 27 active, and you went from 2 people in the drop to 1 person in the drop. So the total number of firefighters actually went down a little bit between 10/1/19 and 10/1/20, which is probably just a snapshot. I mean, there were probably openings at that time. I'm not sure. But the fact that your number of active non-drop went down, your payroll went down for that reason, that actually increases the cost as a percentage of payroll, because we've got a flat, UAL mortgage payment. And then if you have a smaller payroll, that represents a larger percentage. So the high turnover at the top here, the 9 people that terminated, that helped the plan. But the fact that you have a little less membership as of 10/1/2020, that hurts as a percentage of payroll. So a lot of these things kind of, interact with each other and offset each other. At the bottom of the page, luckily there was no mortality, but that actually hurts the plan a little bit if everybody survives and gets 1 more year of benefits. The GASB information, the city has to put a liability on their balance sheet for the pension plan. And it's called the Net Pension Liability. And that actually stayed about the same. Last year was 1,676,000, and this year it's 1,625,000. And as a funded ratio, that went from 87.3 to 87.9. So, from how well funded the plan is, health-wise, plans try to be in the 80 to 100% range. So you guys are well in that healthy range at 87%. And one reason why these liabilities stayed pretty flat is because the GASB there doesn't use any smoothing. It just says what's the market value of the 1 year and what's the market value of the next year. And so that experience was that 8+% return that you got for the 1 year, not the smoothing 7.7%. So then the unfunded actuarial accrued liability, that's the measure on the, with the smoothing and everything, where we are compared to where we'd like to be each year. So last year, the unfunded actuarial accrued liability was 1,519,000. We expected it to go to 1,466,000 because we make a payment each year to pay that down. And in the end, it was 2,013,000. And this shows you all the little contributions to that. And so the investment return using the smoothing, we had that 7.7 instead of 7.6. That was $11,000 gain. Salary increases was basically neutral. You know, they must have been about what we expected. The high turnover, more turnover than expected, that was a gain of 30,000. That reduced the liabilities by 30,000. The fact that no one passed away, that increased the liabilities by 48,000. And then we had a member buyback, and I know you guys discussed this at a meeting, a couple meetings ago. And we had a member that had some past service. And the question was, you know, how much should he pay for that past service? And how much should be on the city and that kind of thing. And the method that you guys used, you know, the member paid a certain amount, but that wasn't really the full value of that extra time. And so we knew we were going to have a loss in this valuation report. So that was a loss of 228,000. And so that's another reason on page 5, you asked why the costs went up on page 5. That was another piece of it, is the member buyback. And then the assumption and method changes increased the liabilities by 282,000. And so there was 3 factors for that assumptions and method change. One, what we already talked about, was fresh starting the assets, the smoothing technique. The second one is the state mandated a few years ago that every plan has to use the same mortality assumption as FRS. And so we had to change this year to match FRS. But that actually helped you guys this year. That reduced the liabilities a little bit. And the other good thing is that it's using a public employees mortality table. So it's looking at police officers and firefighters from around the country. They did a study of their mortality. So your new mortality table is actually more accurate than the old one. So that was a good thing. And then we reduced the investment return assumption from 7.6 to 7.5. You guys did an experience study about 5 years ago, and you said, well, let's reduce our assumption from 8% down to 7.5%. But we don't want the city's cost to go way up. So we did it over a 5-year period. So each year we reduce it another 0.1%. And this is the last year we're doing that now. So this year we went from 7.6 to 7.5. So all the assumption changes and method changes put together did increase the liabilities there by 282,000. But now we're using a better mortality table. We have a fresh start on the assets, and we're using a lower interest rate going forward. So I think those were all good things that happened there. So this page shows you the funding requirements, the pieces. So the first piece is the normal cost, and that's just the cost of each member accruing benefits 1 more year. And that's kind of based on the average entry age of the members. And so that would have went from 16.4%. That's what it was last year. If we didn't make any assumption changes, it would have been 15.7% of payroll. With the assumption changes, it's 16%. Administrative expenses went up a little bit. And then the last piece is the payment required to amortize the unfunded. And so we had a little bit of a loss this year. And then we had assumption changes. So that went from 12.1 to 14.5 to 16.2. So you can see in that middle column, if we wouldn't have made any assumption or method changes, the cost still would have went from 30.3 to 32.6. and then another 2% for those assumption and method changes. So I know that was a lot of information. Does anybody have any questions about it?
Any questions?
I mean, you guys, your costs went up this year, but you guys are still in great shape. You know, a city requirement of 23% of payroll is still a nice requirement relative to most of my plans.
19 sounds better.
Well, Burgess is going to come after me and he's going to tell you that you're off to a great start on the investments this year. So maybe next year it'll go down.
Seeing no other questions on the Foster report, is there a motion to approve?
Scott Mast, motion to approve the Foster report.
Is there a second?
Second.
Any further discussion? Questions call, all in favor say aye.
Aye.
Opposed, motion carries unanimously. Thank you
I
very
just
much.
wanted to
Mr.
bring up
Conley.
I just wanted to bring up one thing I mentioned when we were doing it. Is that experience study. So we did one last time, September 19th, 2016. You're supposed to do them about every 5 years. So that would be, you know, this summer. So the board might want to have, you know, authorize me to do an experience study over the summer. And what we would do is we would look at your experience relative to our assumptions. So like turnover, you had more turnover this year than our assumptions. Our assumptions are right here. We're assuming 15% in the early years, and then 10% from 5 to 14 years, and then 5% at 15 years. You know, those were all based on the experience we had 5 years ago. And so, you know, if we did an experience study, we'd show you how many people are terminating based on their service, and then recommend changes to the assumption. And then we would show you what that would do to the funding requirements. So if we were to increase those rates and we assume more people are going to terminate, then we're going to assume less people are going to retire, and then the funding requirements will go down. And so salary increases, you can see there, we have an assumption about 10% the first year, and then 5.5%, and then 5.25%. So we would look at that assumption. And then the investment return, you know, we just changed it now to 7.5%, but the Florida retirement system is actually at 7.0%. So I think we may want to consider continuing to drop that investment return assumption. And so the experience study would show you your actual returns. And then we would show you, well, what if we change it to 7.25% or 7%? What would that do to the funding requirements? So it's a good exercise for the board to do, you know, to look at what they should do for the investment return assumption. And so our minimum cost for that study is $7,500. So that's what I would charge. So you don't have to make a decision today, but I think the auditors would agree that an experience study every 5 years is appropriate.
Okay, unless there's I guess an itching to do so right now, we'll bring it back for the next meeting for consideration.
Sounds good.
Thank you.
And then one other thing here while we're on my topic on the valuation report. The state many years ago decided that every year you have to do a declaration of the expected return for the next year, the next several years, and the long term thereafter. It's a dumb exercise because you guys talk about your investments all the time. But I think the board should make a motion to declare the expected return for the next year, the next several years, and the long term thereafter will be 7.5% net of investment related expenses.
I'll entertain a motion at this time. Is there a motion? Anybody going once?
You can just so moved if you want.
Is there a motion as to the expected return?
The question, will we change this once we potentially go to the state expected return of 7.0? Or should we just go ahead and say 7.5 near, mid, and far term? Patrick?
Yeah, right now you need to declare 7.5 because that's what we used in the valuation report. And then over the summer, we'll do that study, or even if we don't, and you guys decide to lower the assumption in the 10/1/2021 report, then we'll change our declaration that year. But for now, you want it to line up with the current valuation.
Fair enough. Like to make a motion to the board that the net of 7.5% of expenses be our declaration for return on the police pension board accounts.
There's a motion on the floor. Is there a second?
Second.
All in favor, say aye.
Aye.
Aye. Opposed, motion carries unanimously. Thank you, Mr. Donna.
Sure.
Moving the agenda to Capital City Trust, Mr. Madrid.
Good afternoon. How are you?
Great.
I guess Jill is going to put the report up on the screen, but it's a report you may have in front of you with the blue stripe on it that looks like that. Inside on page 2 is the policy review. There we go. Page on down, please. Okay, so this is for the fourth quarter, which was a good quarter. I'd just like to go over the positioning of the fund. Currently, we are still overweight large U.S. equities at the expense of being underweight the other asset segments like international, especially mid-cap and REITs and infrastructure and convertible bonds, and then fixed income or Sawgrass is about neutral. And so let me just give a little bit of color as to why this is the way it is. When I deviate from the strategic model that Burgess assigns to the fund, I want to make sure that there's a high level of predictability and consistency. And I find that predictability in the US large companies like Apple, Amazon, Microsoft, Target, Walmart, Merck, Johnson & Johnson, and Berkshire Hathaway. So that is in place to provide predictability. International has less predictability because, in my opinion, their companies do not grow as fast as ours. Their central banks are not as well coordinated, and historically, their currency jumps all over the place. So for stability purposes, I tend to lean towards a home country bias. Now, the next thing I want to go over with you is when I do reduce equities, last year, I took it out of convertible bonds because I did not want to take it out of mid-cap and small-cap stocks because that area is where there are a lot of consumer cyclical or economically sensitive companies that do well during a recovery. And so I wanted to leave those 2,600 companies alone, let's say, and reduce the exposure to convertible bonds. However, convertible bonds have an optionality that can make a bond price go up quite a bit. That optionality is difficult to predict. It's like buying a call option and trying to predict where it's going to go. Convertible bonds did well last year because of that optionality in technology companies and electric vehicle companies. Nevertheless, it was a small allocation my underweight was a small underweight to the policy, and therefore it hurt, but not much. So I still feel going forward that small cap and mid cap is a good place to be because of the consumer cyclical companies that are in those indexes. I still like infrastructure. The number one holding in infrastructure is Florida Power and Light, which tends to be a defensive stock and does well during recessions, but doesn't do as well during a recovery, at least not as well as Target. So I've remained a little bit underweight in infrastructure. Any questions on the policy allocation? If not, we can go on to page 4, which is the performance. So this is for the fourth quarter. For the fourth quarter or the latest quarter, which is the column on the left, 15.85% for the quarter, which is a good return. And for the year, 18.98%, which is outstanding. As the economy recovered, the election was over, interest rates came down, which spurred money into growth stocks. The fund outperformed the S&P 500, which is not an easy thing to do. Bonds returned 13.75, and that's largely because of the convertible bonds doing well. Real estate returned 9 as real estate starts to bounce back and businesses reopen and start to repay their rents or pay their rents again. And so over the last year, real estate was negative, but we were underweight in real estate. And you can see there on taxable bonds, 31%. That's the convertible bonds kicking in, their optionality of technology, internet, software, and electric vehicle bonds going up in price. And then cash is paying next to nothing. So based on the low interest rates and low interest rate environment that tends to push growth stocks up, makes them look more attractive. The fund did very well. Of course, that can work against you when interest rates go up, technology stocks fall back, and then I look to buy on the dip. So my strategy this year, as there's more volatility in the stock market due to the rise of inflation and interest rates, is to buy the dip. So if there's a 2% dip in the S&P 500, I'll go in and buy a little bit. Any questions on the performance?
This is Burgess. I see a number there, 8,838,000.
Right, that's the total combined equity that we manage without the infrastructure.
Well, there's something else. So infrastructure is 444,000. So I
Right.
think the
bonds are not in here.
the Sawgrass bond. So when you say the total fund, it's just really a subset of the total fund. The total fund was 13 million at the end of the year.
Right. At the top of the page, it says Palatka Police Combined Equity. So that's, I guess we call that what we manage is the combined equity without Sawgrass.
Okay.
Yeah.
Just be clear.
Yep.
So they understand what's going on. Thanks.
Yep. And then if you page down to page 5, I threw in January. January was a month where the market treaded water due to the threat of rising interest rates. And but that's just there for information purposes. But February and March have been good so far with the vaccines rolling out. I'm even seeing companies that are associated with travel and leisure start to spike up, like AMC Theaters and Carnival Cruise Lines and American Airlines. So the second half of this year, many economists predict the economy will do quite well. And we're in a position to be there because of the heavy weighting in growth stocks in the S&P 500 and the mid cap and the small cap. If you page down, please, to page 7. You can see the asset allocation as of March 1st, we're 59% equity, which does not include the infrastructure, which would make equity about 63%. And then you can see the yield of the real estate, the yield of the equity, and the yield of the fixed income. And so you're in a moderate growth portfolio in terms of your equity allocation. It's not aggressive, but it's not middle of the road either. It's a good growth strategy. And that's all I have. Are there any questions?
Seeing none, I'll entertain a motion.
Scott Mass, motion to accept the Capital City report.
Second.
There's a motion on the floor and a second. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you, Mr. Madron.
Thank you.
Moving on, Burgess Chambers,
you.
BCA report.
Thank you, Mr. Chairman. Jill's doing it. She's going to take you to page 15. On page 15, going back 10 years, 5 years, and so forth, you can see the quartile rankings of the entire peer group. This is probably the largest peer group of defined benefit or pension plans available. And those 4 different colors in each time period represent the 4 groups or quartiles. And you want to be above the middle. You don't want to be in the red zone. And I think this is illustrative of how consistent the rankings have been above average. For the 10-year period, 47th percentile was right above average, which would have been 50th percentile would be average or median. 5 years, 3 years, 1 year, and so forth are all well above average, and that's good. And when we look at your peer group and how they're investing compared to you, what we've determined is that you are much more U.S. centric in terms of stocks. You do have international, but less exposure to foreign stocks than your peer group. That's paid off well, certainly over the last 10 years. In the last 15, you have no exposure to foreign bonds. Your peer group does. You have no exposure to what we call private equity, which are illiquid, long-term hold propositions. And so really, you're different. You're different than your peers. And I think if you want to be just like your peers, then the expected return, your historical return would have been lower. I think Dwayne has done a fabulous job in investing where he has strong convictions. Now, if you go to page 13, Jill, shows the steady hand of a brain surgeon. Page 13, you can see in the upper right-hand corner, the 10-year average net of fees was 8%. And our objective was 8%. Now, of course, Patrick has strong-armed you down to 7.5. I'm saying that lightly, jokingly. But point is, your mission 10 years ago was to make 8, and you made 8. I mean, you didn't always make 8% every year, but the average, which is the important number, was 8. The 5-year was 10.5. Patrick is using a 5-year smoothing mechanism now. So that'll be something we focus on in discussions going forward. A question might be raised, well, if you're at 7.5 now, does that mean the asset allocation, does that change? And the answer is no. We're recommending you leave the allocation the way it is, which is a 65% weighting among equities. I wanted to show where the risk is. I wanted to show you page 17. back to a reference that Dwayne made about moderate risk. If you look at, these are two different time periods, these scattergrams. And these little symbols represent different types of risk assets. The vertical being the historical returns and the horizontal being the risk or the volatility. You can see at the lower left, the little plus sign, that's bonds over historically on these two time periods have had the least amount of risk. And you can see the most risk were the equities in the upper right-hand corner, the northeast quadrant. Your target and your experience was right in the middle. That blue dot is right, that little capital line we call it, which links the bonds to the equities and that outfield, if you will. That capital line, if you want to move up that capital line, you got to move the equity exposure higher. That's what we were talking about earlier. But you're right in the middle. So it's a balanced account strategy with moderate risk. And you can see it right there. Any questions? You go to please to page 11. Wayne touched on these various asset classes. You can see that the domestic equity component for 1 year, 18.6%. And you can see the three pieces that make up the domestic equity. Cohen and Steers did not have a very good year, but we just kind of getting started with them. Infrastructure. They invest in toll roads. That business was down last year with COVID. They invest in airports, down last year. They invest in railroads. That was down last year. But they also invest in cell towers, 5G, all that build out. So right now what's happening is the airports are now gradually getting back. The ports are coming back. The toll roads are coming back. So this should be a nice post-COVID play. And that's why we're putting some emphasis on it for today. The Barclays Convertible Index was your big winner for the year of 54%. It really was a kind of a tech growth proposition last year because there are a number of tech names that are in this. Even though they're bonds, they have the ability with the equity optionality, as Dwayne mentioned, to move upward very quickly as the common stock underlying common goes up. Any questions about so far? So then if we go to the summary on page 4, this is it. We'll wrap it up here, kind of roll it all together for you. Your dollars earned for the quarter and 1 year are here. They're very strong returns and rankings. And you can see the 10-year figure here. You earned 8.2 million over the last 10 years. 8.5 gross, 8.0 net. I really don't have any recommendations today. Just keep it the way it is. And I think Dwayne's doing a good job in tilting where he sees opportunity and where he wants to perhaps tilt away from risk. You also, in your handout materials, should have a supplement that's buried maybe in the back of your books. And if you're curious, I know you are, otherwise you wouldn't be board members. Did I say boring members or board members? Board members. Like the first, did you find it?
Yep.
So like on the first page, it says Vanguard Institutional Index. This is tracking the S&P 500. And you can see on the right-hand side here, beginning with Apple, which represents 6.7%, Microsoft, Amazon, Facebook, Tesla, so forth. So you can see where the money, you own a lot of great companies in these indexes. So as you go through in your spare time, you get a sense of where these funds are invested. And these are the funds that you're invested in. Okay? And that's all I have.
Any question? Seeing that, I entertain a motion.
Scott Mask, motion to accept the Burgess Chambers report.
Second.
There's a motion on the floor and a second. Is there any further unreadiness? Seeing none, all in favor say aye.
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 Opposed, motion carries unanimously. Thank you, Mr. Chambers.
Yes, sir.
Next up is Klausner, Ms. Harvey.
Good afternoon, everybody. Can you hear me?
You can.
Good, thank you. If we could just go a bit out of order. The first item under the attorney's report is the CIT agreement, and Ms. Jill has it up. Perfect, great. This is the proposed policy regarding contractual provisions for investment managers. So these investment manager agreements that we work on, oftentimes they reference board policy regarding these agreements, and the board doesn't currently have a policy in place. So what we wanted to go ahead and do is draft a policy that talks about what our firm likes to put inside a side letter, what provisions we like to ask the investment managers to agree to that are not already in the primary agreement, which would be the investment manager agreement. So some of the policies or some of the provisions that we are seeking in our side letters would be for your investment managers to agree to being a fiduciary to the plan. A fiduciary defined under ERISA, although your plan's not governed by ERISA, the definition for fiduciary is the same. We ask for a most favored nations provision, which simply is if there is another plan that the investment manager is working with that is similarly situated to your plan in the size, in like size and the amount of funds, and they are receiving a lower fee, that the investment manager advise the board and that the board is able to get a similar fee as to the other plan. We seek a no waiver of rights. So the plan is not waiving any of their rights to sovereign immunity or any defenses or anything like that. One of the other provisions we're trying to get into our side letters is for your plan's investment policy statement to be a supplement to these agreements. That Florida law is the governing law. For example, the side letter that we're working on with Sawgrass for the collective insurance trust is their governing law is South Dakota. So it's very important that they agree that the law for this plan be in Florida and venue more specifically be in Putnam County. Some of the other legal provisions that we like to put in there or that we have to put in there is the public records law provisions, that none of the investment managers are on the convicted crimes list, convicted vendor crime list, and then the sunshine law so that they know that all the meetings that we hold are open to the public. And there's a new one that we have to put in as of January 1, 2021, which is the E-Verify. E-Verify is, it's also on the agenda for today. And what it is any new vendor that the board hires after January 1, 2021, they have to register and use this E-Verify system. It's a free system and it verifies the work status of all the vendors and any subcontractors that the vendor uses. The board also, as a public entity, would have to sign up for E-Verify in the future too. So if Jill needs any assistance or if you haven't done it yet, Jill can reach out to us and we can help with that. We'd like to have that the board is given reports on a quarterly basis of any of the progress and what's going on with the investment managers. We also like to have payments in arrears. And there's a few other ones, but those are the bigger ones. Were there any questions about that? I know there's a lot in that policy, but if you have any questions, let me know. And again, this is just so you all, so when I say side letter, some people may not understand what a side letter is. And it's just, like I mentioned, it's a separate agreement where there are terms and provisions that were not included in the investment manager agreement, that these provisions are favorable to the board. Sorry, and then the last one is, I'm looking at it here, the policy, we recommend that the policy be reviewed and updated if needed, about every 3 years.
Any questions as it pertains to the proposed policy?
If there are no questions and the board would like to adopt it, then a motion would be in order. If the board would like to table it for further discussion or anything, that's available as well.
What's the pleasure of the board at this time? Any thoughts or concern from the board as it relates to the policy?
No concerns here.
If there are none, I'll entertain a motion to accept it.
Motion to accept the contractual provisions for investment managers.
There's a motion on the floor. Is there a second?
Second.
Motion on the floor, second by Mr. Cummins. Any unreadiness? Seeing none, all in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you, Ms. Harvey.
Thank you. And Ms. Jill, if you can get the signatures and send us a executed copy when you get a chance so we can have it for our files, that would be great. We did the E-Verify memos. Again, that was about the vendors that have to sign up. Any vendors that the board hires after January 1 of this year, they have to register with E-Verify. Again, your board would have to register as well, as it's within the definition of public entity. Our firm, you hired us before January 1, but we are already registered with E-Verify. Any questions on that?
Just one, what's the cost on E-Verify?
There is no cost, and
Okay.
we have registered.
We've
I
already
have
registered.
Yeah.
Wonderful.
Very well.
And the last one, your update on the collective insurance trust. The agreement or the subscription agreement has been completed. We drafted a side letter to that agreement, and it is currently, it went before Sawgrass and Alta, and they came back to us with some questions or some revisions, which we addressed, and it is back on their desk. As of this morning, Sawgrass let us know that it's still being revised or reviewed by their legal counsel.
We will await the changes.
Yes, thank you very much. And that's all that I have under the attorney's report for today. Thank you.
Thank you very much for your report.
You're welcome.
Next up, expenditures. Ms. Kaiser.
These are the expenditures for the first quarter, for police pension.
Any questions as it relates to the expenditure shown? If not, I'll entertain a motion to approve expenditures as written.
Scott Mass, motion to approve the expenditures as written.
Second.
There's a motion on the floor and a second. Is there any further discussion as it relates to expenditures? Seeing none, all in favor, say aye.
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 Aye. Opposed? Motion carries unanimously. Thank you, Ms. Kaiser. Next up is public comment. Public comment will be limited to 3 minutes. No action will be taken on topics of discussion. Anyone wishing to speak during public comment can use the YouTube live chat function, or you can dial in 386-329-0100 extension 0.
There is no public comment.
Seeing no public comment, at this time, we're going to close public comment. we'll move forward to other business at this time. Is there anything else before the board?
The only thing is a reminder that we need a fifth member.
Right, you're gonna recruit her?
Elected by the board.
I mean, as far as they have to be a city,
No,
anybody.
yep.
Me. There's no restrictions, yeah. It can be another person from law enforcement as well, correct?
I believe so, yeah.
So we will, and just anyone who's interested in serving on the board just has to fill out the one-page application. And so I think we'll be able to work on having another member. Our next meeting is scheduled for what? So. Our next meeting scheduled in June. We'll get notice of it so we can mark our calendars. June
Excuse me, June
15th.
15th, yes.
June 15th is the next scheduled meeting. We should have calendar invites coming out soon. If there's nothing else before the board at this time, we will stand adjourned. Time is 2:31.
Nice to see everybody.
Likewise.
Bye, everyone. Thank you.